FY22 earnings conference call of HDFC Asset Management Company Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. From the management team, we have Mr. Navneet Munot, MD and CEO, Mr. Piyush Surana, Chief Financial Officer, and Mr. Simal Kanuga, Chief Investor Relations Officer. I now hand the conference over to Mr. Simal Kanuga, who will give us a brief, following which we will proceed with the Q&A session. Thank you, and over to you, Mr. Simal.
Thanks, Nirav. Good evening, everyone, and hope all of you, your families are able to manage the Omicron or third wave, whatever name we call it by. Most of the people in our company as of now are working from home. The transition to work from home once again has been smooth. Start with quick update on industry numbers. We always spoken about AUM and net flows. We thought it would be useful to throw some light on gross flows, especially on equity side of the business. For the first 9 months of the current financial year, gross flows into equity-oriented funds have added up to rupees 4273 billion. That is 33.3% of equity AUM at the start of the financial year. Net flows during the same period were rupees 1711 billion. That is 13% of the equity AUM at the start of the year. Equity-oriented AUM as at end of December stands at rupees 17.7 trillion, up from rupees 13 trillion at the start of the financial year. In the debt category, industry saw net outflows of rupees 584 billion for 9 months ended December 21 and rupees 539 billion for the quarter ended December 21. Liquid funds have seen net inflows of rupees 359 billion and rupees 333 billion for 9 months and the quarter ended December 21 respectively. We now move to us. We closed the quarter with an AUM of rupees 4367 billion and the average for the quarter was rupees 4471 billion with a split of 46-54 in equity to non-equity oriented assets. We continue to service 98% of PIN codes across the country through our 227 branches and 1,207 employees. This would not have been possible without the efforts of our 70,000 plus distribution partners. Our market share in overall AUM stands at 11.7% on QA AUM basis and 12.9% if we exclude ETFs. On actively managed equity-oriented AUM, our market share stands at 11.6%, 14.6% on fixed income, and 14.8% in liquid AUM. All these numbers are based on quarterly average AUM. Individual investors are now 59.4% of our total AUM. 5.7 million unique investors have trusted us with their capital. For the month of December 21, we saw inflows of rupees 11.9 billion across 3.44 million systematic transactions. We launched 2 new funds during the course of the quarter. One was multi-cap fund, another an index fund called HDFC Nifty Next 50 fund. The AUM of the multi-cap fund as of end of December stands at rupees 43.53 billion. Over the next few quarters, we propose to launch few more sectoral and thematic funds, index funds, and also some ETFs. We are also exploring passive funds in fixed income space. We made an announcement in December of setting up a wholly owned subsidiary in IFSC, that is Gift City Gandhinagar. We'll be launching multiple funds to cater to international investors through this company. We hope to go live with this company during the course of the upcoming financial year, subject to regulatory approvals. We now move to financials. The overall financial performance of the company during the quarter ended December 21 is similar to the corresponding quarter in December 2020. The revenue from operations increased due to an increase in AUM as well as more remunerative mix with higher percentage of equity AUM. However, this increase was tempered by a dilution in margins in some of the schemes. Other income for the quarter ended December 21 is lower than the quarter ended December 20. The company is in process of expanding its product bouquet and consequently there is an increase in expenses on new fund offers. There has also been an increase in routine business development expenditure as the business moves towards normalization. In February of 2021, a grant of ESOPs was made to certain employees and the expense head, employee benefit expenses, includes the pro rata amortization of the fair value of these ESOPs as required under the Ind AS accounting framework applicable to the company. This is a non-cash charge which is book value neutral. In third quarter of FY22, this non-cash charge amounted to rupees 173 million. As communicated earlier, employee benefit expenses have increased as the company resumed its practice of annual increments in employee remuneration this year after taking a break from the practice last year due to COVID-19 pandemic. This is Piyush's last investor call as HDFC AMC CFO. He leaves us on 31st of Jan and Naozad Sarwala takes over from him starting 1st of Feb. Naozad joined us in mid of December and has been working alongside Piyush for over a month. We also have Naozad on the call with us today. Naozad has over 26 years of experience and comes to us from Lupa System Investment Advisors. He has worked with KKR India for over 6 years and prior to that with Kotak Group, including Kotak Investment Advisors for over 13 years. Thank you very much for listening and we welcome your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Dipanjan Ghosh from Kotak. Please go ahead.
Hi, good evening, everyone. Just two, three questions from my side. One, obviously, on the yields, if we see that, if I look at the quarterly average AUM and look at the equity mix, that has increased by around 600, 700 basis points over the past year on year, while the yields broadly remained flat. So if you could shed some light. My second question is, if I look at your sequential increase in investor accounts versus your sequential increase in unique customers, there seems to be some dichotomy. So is it because in most of the NFOs or in some of the new fund offerings, probably the existing customers are contributing a higher share of incremental flows? And my third question is, if I look at your market share for the individual segment and active equity individual segment and segregate it into channel-wise, direct and regular, probably the market share losses in the direct channel has been significantly higher, be it in T30 or B30 compared to regular. So if you can, shed some light as to what is happening in some of the direct channels and we saw the incremental flows to some of the cross flows to some of the digital channels. Is there some pressure on that? That's all from my side. Thank you.
Hi. So first, on the margins, I think this is something that we have discussed many times over the past couple of quarters. The challenge on this front has actually got further magnified due to high gross sales in absolute terms as well as a percentage of outstanding equity AUM that the industry is seeing. So let me try and explain this to you with an example. So the size of equity-oriented mutual fund industry is some 17 lakh crores or 17 trillion rupees. Gross monthly sales are around 50 to 60,000 crores. So if you annualize that number, the annual gross sales is 35% of industry AUM, while net sales is approximately half of gross sales, which is like 17-18% of industry AUM, or actually even lower. So just qualifying that, the numbers I'm talking are purely illustrative and nothing else. Say industry as a whole is, say, making 70 basis points or so on equity-oriented AUM and 30 to 40 basis points on new flows. And net sales over the next 2 years is, let's say, 25,000 crores a month. That is roughly 6 lakh crores over these 2 years. So what will happen to margins? Assuming no mark-to-market gain, AUM will go to 23 lakh crores or 23 trillion rupees. But this AUM will have new flows of 12 lakh crores and 11 lakh crores of old AUM. That will be the breakup of the new 23 lakh crore number 2 years later. So industry will roughly have 50% allocation each from new and old assets. I repeat, just to qualify that the numbers I'm talking are like purely illustrative and nothing else to explain the thing. And I'm probably oversimplifying things here, but this is the best way to explain what's happening. So it would be pertinent to note that lower gross flows, or for that matter, higher net flows as a percentage of gross flows, can alter the situation totally. Or for that matter, rapid rise in the market coupled with lower gross flows can also make margins look very different. The good news is industry is realizing and pricing products better. What we saw happening with some of the NFOs in the recent past is now getting better. Our past experience over the last several years says that far way out of normal pricing can't last forever. In fact, I would say that actually high distribution costs will ultimately hurt distributors the maximum, because direct plans will become cheap and migration from distributor folios to direct folios may happen at a much faster pace. So I guess key distribution partners are realizing this phenomenon. So what is our strategy in times like these? So we want to balance between two extremes. We are not keen to do business at any price. At the same time, we do want to not be away from all the action. So we're doing much more on the other hand to create the pull for our products via advertising, via communication, the new product launches that Simal talked about. In fact, we have done 6 NFOs this year, which would be more than what we would have done in last several years, what we have done in last 9 months or so. Enhanced interaction, including the knowledge flow, working on our, let's say, the customer data platform, working on, the partner integration through the APIs gateway, marketing automation, so on, a variety of other things that we can discuss. Again, coming back to this pricing pressure in the market, we have lived through these kind of times in past, and look at what happened in 2007-8, or for that matter, I think let's go back to even 99-2000. I'm not talking from market or valuation perspective, but the way mutual funds got sold, and as they say, history does not repeat, but it does rhyme. Lastly, we have all been hungry for growth and have actually paid for our growth. In fact, I would say about our industry that we are now $500 billion industry. I'm talking about mutual fund industry in India, $500 billion of AUM. But if you look at the profit pool, it's around $1 billion of profits. I would like to believe that with more players getting listed and some of the listed players with strict margin discipline will change the way we do our business, and it's just a matter of time is what I believe.
Sure. And on the second question, I think the difference between folios and customer accounts, unique customer accounts sequentially, looks a little bit different. So is it that on the NFOs probably we are kind of getting a lot of the older customers are kind of getting the flows out there?
Some bit of on that account, some bit maybe some of the older people may have booked some profits. So net, I think the growth in folios as well as unique account is almost same. Yeah, that observation is right.
Sure. And lastly, one question. If I see your market share for the retail and HNI segment in active equity and break it across channels, regular and direct, be it T30 or B30, we have seen moderation, much higher moderation in the direct channel in terms of our market share compared to in the regular channel. This I'm specifically talking only for the retail and HNI active equity segment. So just wanted to get some perspective as to what is happening on those channels and how to think about it going ahead.
So direct also include fintechs as they are the RIAs and feed money into the direct plan. And over the last couple of quarters, in fact, very pronounced in this financial year so far as well as in the last financial year, not so much in the year before. They are growing at a rapid pace. And just let me give you some industry numbers here. This is some broad estimates from the data that we have. The total AUM of theirs is around 55,000 odd crores, of which 40,000 odd crores is in equity-oriented funds. More relevant point is that fintechs as a group have registered over 6 million SIPs in the first 9 months of the current financial year. So this is a key distribution channel. And I think at our end, I think we are trying our best to integrate our platform with theirs. We have the partnership with all the key fintechs. Our teams are working off building this further. But just to keep one thing in mind that some of the products which are getting sold there, for example, I mean, one of the highest selling product on these platforms over the last few months has been technology funds, a product that we don't have. We have seen that over a period of time, it's important that we have the right set of products for our customers. And majority of these fintech customers are young and first-time mutual fund investors. So another big focus at our end has been on the investor education and investor awareness campaigns, etc. How do we ensure that we sell the right product to the right investors? And over a period of time, I think we also believe that our market share within these platforms should also go up compared to where we are today. Otherwise, in most of the other channels, I think we would be in line with the industry. Of course, I think you need to keep in mind that a couple of bank-sponsored AMCs have an advantage where there could be a guided or there could be a closed architecture when it comes to the products sold by them. But if you adjust for that, then yeah, I think we would be in line with the industry.
Sure. Thank you, and all the best going ahead.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Anshuman Dev from ICICI Securities. Please go ahead.
Yeah, good evening to all, and thanks for the opportunity. My question was regarding our initiatives on the passive sides. We have been taking some steps on that for the last 2-3 quarters, and you also mentioned some of them in your introductory comments. If you could give some more color in what is our strategy on the passive sides, both on ETF and alternate space, and what portion of the, what portion of revenue or what kind of business we can look from this segment maybe in some 3 to 5 years outlook. Thank you.
So on the passive side, I think we have been repeating it over the last couple of quarters that I mean, at the outset, I'm a strong believer in active management, and as an organization, we have stated this earlier, and we want to repeat that if it comes to it, we will be the last man standing in terms of active management. We will leave no stone unturned. We'll put in all resources required, management bandwidth to sum it up. I mean, whatever required to create value for our customers. Having said that, there is a segment which is looking at options on the passive side. We have been filling up our product bouquet. For the last few months, we have done 2 index products. We have got approval for 2 more index funds. I mean, Nifty 100 and Nifty 100 equal weight that will be launching soon. We've got approval for 9 ETFs that we will be launching for the next several months. We are exploring the ETFs on the debt side as well. Silver ETF is another category where we would like to be present. So I think there is a whole game plan in terms of filling our product bouquet on the passive side. And I would say that we would like to be a relevant player on the passive side and a dominant player on the active side, simply because we also have to keep in mind the pricing and the margins on the passive side and won't like to grow the AUM just for the sake of it. I think the HDFC group moorings in us won't allow us to do that, but we want to ensure that we have the full product bouquet. We remain a one-stop shop for all kinds of solutions, be it in the active space or in the passive space for our partners, for our investors, and doing everything possible to get a relevant, I would say, a share on the passive side as well.
Right. And just one, so basically in terms of the, you're saying we will be a relevant player. I get that sense. And but in terms of infrastructure or in terms of employees, all kinds of requirements are already, we are all ready with that in terms of these new initiatives?
Yeah, absolutely. I mean, we have a fund manager who's been a veteran in the passive space for a long time. Historically, maybe a couple of years back, this market was very small. Initially, it grew mainly because of the flows from the couple of institutions, which were a mandate to few AMCs. But as the market is expanding, I think we are looking at everything to ensure that across all channels, as well as, in the all investor segments, we have the right products in place. We have the right processes in place to reach out to all investors on the passive side as well.
Thank you. Thank you.
Thank you. Participants, you may press star and one to ask a question. The next question is from the line of Aditya Jain from Citigroup. Please go ahead.
Thank you. So thanks for that explanation on the impact of the NFOs. Just a follow-up on that. So if you think of the impact of this on the financials, would you say that a lot of that is already in the AUM? So the reason I say that is, as an example, the multi-cap fund was launched in the middle of the December quarter. So, while there is a 4,300 crore AUM at the end of the period, maybe its share in the average AUM might be much lower. So in that sense, would you say the impact of this sort of pricing pressure is yet to come, and could that lead to a drop in yield in 4Q onwards?
I think it's a matter of various things, as I mentioned earlier. It will depend on the nature of gross flows as well as the net flows, how much gain comes from MTM versus the flows. So all of those kind of things. I think NFOs have a certain kind of pricing pressure versus the existing fund. Within the existing funds, there are, the margins are different for various funds, as well as I said, I think if the market grows, market delivers higher MTM gain versus the flows, the picture would be slightly different. There has been highly competitive pricing on the NFOs over the last couple of quarters, which I talked about earlier, and we are hoping that over a period of time, industry will realize that we need to have more discipline on that front, and I guess that should happen sooner than later.
Got it, sir.
But broadly, just to, to make one point that there is a difference between the margin that we have on the book versus the margin that we get when newer flows are coming in. And we need to keep in mind. And again, when I say the new flows, within that also NFOs versus the existing fund. So we need to keep that in mind. Yeah.
Right. Yeah. So that's what I was asking towards, that the impact of the new flows, could it make a difference in the next quarter? But okay, on the second part, the second question from my side, if you could just talk about the yields on the sort of not purely passive, but things like the equal weighted index fund, which is not completely passive, but you could say some sort of layer on top of passive. What kind of yield do these contribute?
So Aditya, on the TER of the equal weight direct plan is at 40 basis points. So the yield would be somewhere around 32, 33 basis points.
Okay. So somewhere between a passive and a active equity.
Actually, if you say active equity, NFOs, they are, I think, cheaper than these days. But yeah, I think look at it this way, like the Nifty 50 index fund, we run at direct plan at 20 bips expense TER, while the equal weight is at 40. And the Nifty next 50 is at 30.
Understood. Got it. Okay. Thank you.
Thank you. Participants, you may press star and one to ask a question. The next question is from the line of Mohit Surana from CLSA India. Please go ahead. Mohit, sorry to interrupt you. Your voice is breaking terribly. May I request you to come in a better reception area, please? Mohit, sorry, we are unable to hear you. May I request you to come back in the question queue? Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, good evening, sir. Just a couple of questions from my side. Firstly, we've seen a lot of outflows from the debt segment overall for the industry. Could you cite some reasons for it, and how do you see the trajectory going ahead for this? And my second question will be on the expenses, as to how do you see the expenses trajectory for HDFC AMC going ahead, with the kind of new NFO launches? Also, some bit more on employee wherein, where are the employee additions and how do you see that trajectory going ahead? So these will be my two questions.
On the debt side, I think over a period of time as RBI takes away the excessive liquidity that got pumped in post-COVID, I think that will reflect maybe a bit of like capex starting at some point in time, the corporate money which is there may shrink, and maybe some of the other instruments, for example, I think some bit of money may have moved to like the debt ETFs, etc., from the actively managed funds. But otherwise, no larger trend that we can see on the fixed income side. In fact, at our end, we are seeing incremental flows. Of course, it's trickling in, not very large, into the credit risk fund as the risk appetite comes back and people are looking at the top-notch players who did extremely well during the entire credit crisis period. So we are seeing positive flows in that particular fund and few other funds. But yeah, broadly, if you talk about the industry numbers, I think we have seen decline in the debt AUM. Your second question was on the overall trajectory in terms of people. So we would have added, I think we added our CTO. We will be adding more people on the technology side, on digital side, on product marketing, some of those. But otherwise, from an overall headcount perspective, it wouldn't have changed much. Within that, as I said, some of these areas which are high focus areas for us, we would have seen people addition.
Okay. Just coming back to the debt flow, so in the past, say like over the last decade or so, we would have seen this debt AUM growing at a decent 10-12% CAGR. Do you think that that kind of trajectory can unfold in the next few years as well?
So if I look at the overall size of bank deposits in India versus the debt mutual fund, and your observation is right. In fact, that percentage hasn't changed. The growth has been more or less in line or maybe slightly lower at times than even the growth on the bank deposit side. So there is a long way to go. I think for the last few years, we have seen significant acceptance of equity as an asset class among the retail investors. The SIP flows that we see are primarily in equity fund or hybrid funds. But I think several of us have grown seeing recurring deposit as a product, which was also kind of an SIP in fixed income. That's a concept which hasn't really taken off. But I guess for a set of investors, that could also be an interesting product. I think as an AMC, we are also thinking of working on that. And I agree with you. I think in line with the overall deposit growth, I think that should be there. In fact, should be higher than that because the mutual funds are clearly provide a good and convenient, diversified, highly transparent, I would say, product on fixed income investing as well. So there's a lot of potential on the retail penetration of fixed income as a product category.
Okay. So I mean, just coming back to the expense part as well. So if you look at our OPEX per AUM, OPEX upon AUM, we are roughly around that around 12 in terms of that. So do you think that you will maintain this or it can trend higher? We've been in at 12 bits for the last 3 quarters. So do you think that this will go higher or this will be at this level and the EBIT is dropping at the revenue level, the EBITDA margins will decline?
So I think for some time it should probably remain at this level. Of course, here you'd have to take into account the ESOP cost, which is that one bit, which that charge kind of whatever we have till now runs out in the next month. So there'll be a little bit of a dip because of that. But otherwise, we're also investing in other things like technology, a little bit more on people here and there. So roughly we should be there before it starts going down again.
And when do you see this trending down? The 3 quarters, 4 quarters?
Let's say a year and a half, probably 2 years.
Okay.
Because we still need to, we are putting in a substantial amount of money in business development costs now.
Okay. Well, thank you so much.
Thank you. The next question is from the line of Ritesh Varjatia from Asian Market Securities. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, we have seen a good amount of the inflows across the industry in past couple of years. and equity is accepted as an asset class, as we also mentioned in previous answers. I want to understand in present situation, how do you face this deployment challenges? Because at one end, central bank across the world is in the mode of rising interest rates to counter the inflation, and that is having the implication on the fixed income market and also on the equity side. So how do we mitigate this transformation time? Obviously, but how do you face the investors this time, and how do you address your investors at this point of
I think the investable universe is expanding at a faster pace than the money that's been flowing to us. We are still a very small percentage of the overall free float market cap in India. I mean, if you compare us with, let's say, some of the other developed markets, I think the total AUM available to invest in mutual funds in India is substantially lower. And without taking names, you would know better the kind of new players who have been getting listed over the next several quarters, the amount of new listings that one can talk about. So we haven't reached the stage where I think there is a lot of money chasing few stocks. In fact, as the rally gets broad-based, the investment universe is only expanding in the existing universe as well as the newer listings that are likely to happen over the next several quarters or rather years in India. So we have a long way to go in terms of the capacity of the mutual fund industry to deploy money.
Yeah, but sir, if we look at last 2-3 years performance, then we also seen action is very much concentrated in couple of the stocks. So does the industry take some more time, or how do you see that?
It's actually changing. So of course, calendar year 2018, 19, 20 were the years where you are absolutely right. Couple of top stocks accounted for bulk of the market return. I mean, if you take the Nifty, the top 5-7 stocks would have accounted for maybe anywhere between 70 to 100% of the returns. But since last year, the rally is becoming more broad-based. In fact, that is also reflecting in our performance. And in our yearbook, I think there's a beautiful slide on that how active managers have done well in past whenever we have seen a more broad-based rally, and this time is no different. I think the alpha generation across most of our schemes has been quite good in last year and a half as rally is becoming broad-based. So that's the point I made earlier, that investable universe is expanding rather than shrinking, if that's the fear.
Helpful, sir. That's all.
Thank you. The next question is from the line of Mohit Surana from CLSA India. Please go ahead. Mohit Surana, may I request you to unmute your line from your side and go with the question, please? Mohit Surana, can you hear us?
Yes, I can hear you. Can you hear me?
Yes, we can hear you. Please go ahead with your question.
Sir, my first question is that obviously you said on an industry level, NFO flows are coming at a lower profitability. So my question to you is, will you not at some point in time increase the expense ratio on these funds, because otherwise then it will lead to cannibalization within existing schemes, right?
Expense ratios are at cap only. I mean, expense ratios are at cap. I think it's the function of the distribution cost that has been paid in these NFOs. And you are right, over a period of time as flows come in at a lower cost, as we see more discipline coming in terms of pricing, obviously, I would say hopefully you will see better margins in these products as well.
Understood, sir. Sir, the second question is on alternative strategies. Obviously, in the past you said that you are on drawing board. So, is there anything concrete coming out of there, and what value will these kind of alternative strategies bring to the company?
So you're right. I think in the last one or two calls we mentioned about we have plans to enter into alternatives, and in the next financial year you will see us launching a product on the category 2 side. We have filed an application with SEBI to for a permission to launch a category 3 fund. Over a period of time, we have ambition to build our presence on the alternative side as well. So that's very much on track. You would have heard about our plans to set up a wholly owned subsidiary in the GIFT City.
Got it. Hello?
Yeah.
Got it, sir. And any, particular value you think that these strategies will bring to the table in terms of profitability, in terms of bringing more investors, etc.?
I think these are early days, and as I said that we have ambition to put up the whole platform over the next several years, but these are like too early, I would say, to talk about the exact numbers.
Sure, sir. Thank you. Thanks a lot for taking my question.
Sure, Mohit. Thank you.
Thank you. The next question is from the line of Karthik from Myriad Asset Management. Please go ahead.
Hi, sir. Thank you for this. I just want to understand if you can give me a ballpark figure on the yield on NFOs versus your existing funds.
I think, different products would have different numbers. In fact, I mean, it's all kind of, you can see the direct TER of the funds of not only of us, but the industry, and can also look at the distributor plan versus the direct plan, and I think you can definitely, kind of do the full scan.
Okay. All right, sir. Thank you.
Thank you. The next question is from the line of Sahaj Mittal from HDFC Securities. Please go ahead.
Hi, good evening, sir. So my first question was around, so I know you answered that, but actually, to better understand things, given that the new NFOs are coming at very steep distributor commission, so what is our strategy going forward? That could we see some mean reversion over there by increasing our net yields, or how do we go about it? And the second was around, if you could indicate some ballpark number, what's the proportion of back book in our current AUM, current quarterly average AUM on the equity side, to better understand, what could be the pressure on the yield in the foreseeable future. And the third was around, are there any one-offs in the other income, given that we have seen some good returns on a sequential basis? So, yeah, those were the three questions.
So again, on the NFO side, on the core categories, we only had one fund category left, that was multi-cap, the NFO that we did a few weeks back, and last year in December we had dividend yield fund. Now our core categories is like almost full. There are few products that we have launched to fill our product gap on the international fund side. On the passive side, thematic is one area where we have done BFSI fund. We have few more funds in the pipeline. But overall, as I think we have been saying that our intention would be to grow as much, if not more, in our existing funds. I think the performance has been looking up. We have one of the best-in-class product range across all categories. We have one of the best product lineup on the hybrid and solution side, where we believe there is tremendous potential for us to grow. Some of the other categories, for example, focused equity, which is like very small for us relative to the size of that category, and Roshi will be managing that fund, and she has a brilliant track record over the last decade or so. And there is tremendous scope for us to grow. Large and mid cap is another category which Gopal is managing, and there is huge scope for us to grow in that. and on the Balance Advantage or variety of other products where we have a lot of potential. So while I talked about the overall margin pressure, because over the last few months, I think financial year till date, out of 1,70,000 crores of equity flows, 40% or so have come through the NFOs. But I would assume that over a period of time, incrementally higher amount of flows would be into the existing funds than the money which is raised in the NFOs. And within the NFO also, we are hoping for, I would say, more better pricing going ahead. Does that answer your question?
Yes, sir, but my question was around, can we see some mean reversion in the distributor commission given that these are at elevated levels? So is there a possibility over there?
I think as I told you earlier that I think distributors also understand that too high a payout in an NFO means much lower TR of the direct plan. And as similar on a lighter note, but I would say on a serious note as well, mentioned when somebody asked the question on the TR of the passive fund that some of the actively managed funds TR is lower than even the passive fund. And you have to invest heavily as an organization to deliver alpha over a long period of time. And I'm sure investors and distributors would understand that the fund houses will have to be well compensated for them for that. So I think we have seen these periods earlier, and I'm sure over a period of time we will see the mean reversion.
Got it. And the other bit was around what the percentage of our AUM would constitute back book on the equity side?
What percentage?
We can't give that, so we don't give breakup. So we just give
some number to understand, for next 4 quarters, or we could do some envelope calculation to understand, for how long this yield pressure can continue, if it is possible.
Navneet explained, right? The yield pressure can continue if the gross flows in the industry are substantial or material part of the outstanding AUM. So if that continues, so we can look at gross flow numbers, because finally gross flow and net flows, what gets added to the AUM is net flows, but what gets gets repriced is the gross flow number. But we can't give that split.
Sure. Thank you. Thank you, everyone, and all the best.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Abhishek Saraf from Jefferies India. Please go ahead.
Yeah, hi. Thanks for the opportunity. So many of my questions have been answered. I just wanted to understand some qualitative color if you can give on a market share, AUM market share, which has been sliding. And so if you can just give me some understanding in terms of the M2M market share or the gross flow market share and net flow market share, where actually we are getting hurt. And also, sir, just one thing that we have also been trying to address this market share losses, and now it's been almost around 2 years that we took some active steps towards that. However, it appears that the results have still not fallen in line. So, what, according to you, still needs to be done that we can start to wrest back the market share, especially in the equity AUM?
Sure. So, we have in past discussed this at length, and we are aware of the reasons behind loss of market share. So let me today spend some time on the AUM and net flow numbers category wise, and I think this should help in understanding how we go about analyzing market share and also the action plan at our end for way forward. And in this process, I might tell you too many numbers, and so do pardon me for that. So let me start with some of the categories which have grown and have become quite large, where our market share in these respective categories is something that we need to address. I think just a few minutes back I talked about the focus funds, which are now like 95,000 crores, nearly 5.5% of the industry AUM, and our fund is less than 1,000 crores or so. So we are like 0.5% of our equity-oriented AUM. And we have catch up to do there. Roshi is going to manage this fund now. She was managing Templeton's Focus Fund. which is among the best performing fund in the category. Our team is working on doing a relaunch of this fund, clear communication of our strategy, and back it up with the information and the distribution which is required. So we hope to grow our share in this category. I'm just giving you 2 or 3 examples so you can understand the things that we are doing at our end. We've also spoken about our miss, though by design, on sectoral and thematic space. We strongly believe that market wasn't ready, and more often than not, risk is something that does not get enough due. But sectoral and thematic funds are now finding some space in investors' portfolio. The AUM for the industry here is 1.47 lakh crores. I mean, as against, let's say, 84,000 odd crores as of December 20. Largest contributor to this growth has been technology fund. And then we would like to believe that this is more to do with the recent performance than anything else. And our AUM in this entire space, I mean the sectoral thematic space, is 4,000 crores. In fact, within that, the 2,200 crores came when we launched the Banking and Financial Services Fund. We have filed or in the process of filing a couple of documents in this space with the regulator, and we'll be launching these funds over the next few quarters. Again, I mean, I think even at the cost of repeating, which we have been saying over the last several calls, that we will launch only those funds which we think have long-term potential and are good investments as of launch date, and not something that is just because it's flavor of the season. HDFC AMC has never done that, and we would like to be very, very conscious of that fact. Another category, for example, is large and mid-cap fund. I think we are at 5,000 odd crores, but our market share is shared under 5%. I think our performance is strong and we'll be able to build on it. Multi-asset allocation fund, or for that matter, the entire hybrid and solution bouquet that I talked about. We have one of the best-in-class, I would say, product bouquet with the long-term performance track record in that category, and there is tremendous opportunity there. So whether it's the large cap, flexi cap, mid cap, small cap, we are looking at each and every category wherever there is scope for us to grow and won't leave any stone unturned. Earlier, I talked about some of the other categories where there are more product launches likely to happen, for example, on the international fund side, on the fund of fund side, etc. And I'm not talking about passive here. We are talking about active funds, because I think the market share loss is something that you asked about. In fact, one of the largest category to see flows has been dynamic asset allocation category, or what's known as balanced advantage. It's seen 50,000 crores plus net flows in these 9 months, and 20,000 crores of that has been through NFO. We have a top tier performance across time period, 1 year, 2 year, 3 year, 4, 5, even longer in the category. In fact, over a 25-year period, I think it's one of the best performing fund in mutual fund industry in India. And I would request you to check out numbers for yourself. And in our opinion, I think our thought process, our style for this category, if there is some misunderstanding in the way people bucket us, I think we would like to address those so better times ahead. We have seen, I think, flows in flexi cap and multi-cap categories because of some of the larger NFOs. We have reasonable share in these flows because of our recently launched multi-cap fund, but still there is huge scope for us to grow there. I mean, I can go on. So we are on the ball. As you would appreciate, these things don't change overnight. I mean, I would like to mention that we are doing everything possible and hopefully should see results sooner than later, whether things on client services side, whether on increasing engagement with our distributors across all channels, engaging them through NFOs, which also helps us. I mean, in our multi-cap NFO, we saw participation of over 13,000 distributors, whether it's the communication, more segmented, more targeted, whether enhancing our digital platform, our customer analytics, providing both investors as well as our distributors newer modes of transacting with us. So I think we are on the ball, and hopefully that you should see the results, as I said earlier, sooner than later, including couple of other things that we are doing. But lastly, I mean, I would like to add one thing, that as an organization, we would always want to balance between market share and margins, because we do not necessarily subscribe to the idea of doing business at any price. we are of the opinion that market share at any margin might not be the best idea. People respect us for that balancing over the last several years. And we would also like to believe that getting share at any price is not a sustainable strategy, and hoping that industry will see rationalization at industry level sooner than later.
Thanks, Naveen, very comprehensive response to that. So just one follow-up. So does this imply that, as you mentioned, that in many funds our market share is low in many categories, so we would be continuing with the means more NFOs would be expected in thematic and other kind of sectoral kind of funds, and so that would be a right assessment, right? And secondly, you had mentioned that recently the NFOs pricing has been more favorable towards the manufacturers. So you can just give some color on means what was the earlier net TER which was accruing to the mutual funds, and what would have been the recent experience?
No, the pricing is not favorable to the manufacturers. But I mean, on the other point on the NFOs, I mean, as I told you earlier, that on the core categories, we are like almost we have presence across all categories. After the SEBI classification, where I mean the categorization of funds, we have presence in almost every category. There are 4 categories: thematic funds, thematic or sector funds, international funds, passive funds, and fund of funds. These are the 4 where I think we have some more work to do in terms of filling our product bouquet. But otherwise, on the core categories, our focus would be on enhancing market share that we deserve in each one of those categories.
Thanks a lot and all the best, sir. Thank you for your response.
Thank you.
Thank you. Next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, thank you for the opportunity again. Just a couple of more questions. So when you say that if the gross flow in the overall AUM increases, so basically we're talking about legacy assets versus new assets. Any sense on HDFC AMC's mix between, say, the pre-TER norm change, in the last couple of years, how this has changed?
So pre-TER, you are saying what was the AUM before on say 1st of April 2019, that way?
Yeah, so basically the mix, how it has changed from the legacy assets versus, so if say in FY20, what was the AUM on the pre-TER, and today what is the share of that?
So we don't have that in sense because so it would be, what he's saying is what money would have gone out and what would have come in. We don't have that breakup.
Okay. Yeah, because that would be the impact that you would be talking about, right? When the new flows come in, which are at much lower yield, not just the NFO, but even in the existing schemes, when the older AUMs are going out of the system and the newer AUM is coming in the newer scheme as well, that would also cause the impact, right?
Yeah, so that's what we've been talking about many quarters. I mean, each quarter we kind of mention this, and it's a continuous process which is going on, and that is